Hello, Maverick Traders. This is Rob Reinhold, and September is officially over as far as trading goes, and we are into the fourth quarter of the year. So let's get into the markets. In this video, we're going to be going over the previous week. We're going to break down all the numbers. We're going to look at all the news that affected the markets. Then we are going to look at the markets as they are right now. We have a saying at Maverick: trade the market in front of you, not the one you want it to be, not the one you think it should be, but the one that is. So we're going to score the market where it is right here, right now. And always we're looking for setups and opportunities in these markets.
Disclaimer: this video was created for professional stock and option traders. Maverick Trading is a proprietary trading firm that employs professional traders around the world. Our traders trade firm capital and keep 70 to 80% of profits they generate. All trades and analysis in this video are for professional traders only. If you are interested in becoming a professional trader for Maverick, click the apply button in the video description. Let's get ready for the week.
Looking at last week's news, the first thing we want to talk about is just the weakness in the markets. This is what I really wanted to spend some time with you and really go down of where we are. Over the last couple of weeks, we've talked about how September 1st to October 15th is historically the weakest 6 weeks of the year. And we've got that again. This last period has been the weakest month of the year. The S&P is down about 5% for the month of September. The Q is down about 5.5%. So this period right here, it typically is the worst month. And yes, this year it was the worst month. We also have a few other things happening out there. We are going into this weekend highly likely to have a government shutdown. Now, again, I don't want to get all over dramatic. About 30% of the government shuts down. And again, what that even means is people don't get paid, offices don't get open. Look, the average government shutdown, I think, lasts 8 days. So it's not that big of a deal. But I wanted to talk about what to expect on a government shutdown. Now, if we take a look at past government shutdowns and we say, okay, what has happened? Typically, the markets fall going into an anticipated government shutdown. When the government actually shuts down, the average return for the market is 0. And I'm going to throw up a chart here, and you can see that sometimes it's plus or minus a little bit, sometimes it's up a little bit, sometimes it's down a little bit. But for the most part, the market stops going down. So going into the government shutdown, markets typically fall around 6 or 7%. We get the government shutdown, the markets basically go nowhere. And then every single time after the government shutdown was over, there was at least a couple percent market rally. Let me throw on one more bit of news that's going on here. We have the auto worker strikes. We have these strikes that are making it to where a lot of cars aren't getting built, a lot of production, a lot of people aren't getting paid. All these things are happening. Now, all three of these things that I've just talked about that have been weighing on the market are temporary things that should be gone within the next 2 to 3 weeks. So we have the seasonality as of October 15th. We typically get a nice rally after that. After government shutdowns are over, we typically get a nice rally after that. And again, this strike, I don't have any numbers for you on the strike, but you can see here that we are reaching the end of this time period where it makes sense to be overly bearish. The markets look extremely bearish here. All the rallies this week were met with selling. It was an ugly week. The market only went down about 1%, but it was still an ugly week for the market. So we had 10-year bonds continued to move up. We'll take a look at a chart on a 10-year bond. But look, everything looks bad now, and I get it. It looks bad, but I want to make sure that our traders are really seeing this for what it is. We are definitely in a -2, -3 market, no question about it. But I don't want people to get overly bearish because all of the things that have led to this could potentially be over fairly quickly. Not a lot of news last week. I do want to point out one bit of news. On Friday, we got the core PCE price index. This is the Fed's favorite inflation number, and it came in even weaker than expected. 0.2 is right in line with what they want. 0.1, even weaker than expected. We had a short-term pop on this, and then, boy, the market sold off all day on Friday to basically close flat for the day. The fears have kind of now shifted more towards, is the economy going to weaken more than the Fed want? We'll see what happens. Let's take a look at last week's trades. We shared 5 trades with everybody. The first one was a sideways play on NRG. And you can see NRG did exactly what we wanted to do. 38 is our butterfly, and the stock was basically down 0.2%. So it looks good here, but we still got more time on this one. We also took a short on VTR. We talked about how this one was making this little ABC run off of a 5-way pattern. So we got this. You can see we did break down that point. We got a little rally, just like the market. We'll take a look at it. But these are not strong candles. This stock was down 1% for the week. We also had a bearish trade on Delta Airlines, DAL. This stock down about 2% for the week. Again, keeps moving down along with the sector and with the industry group. We also had another short on Sunrun. This is a solar company. This stock was down 2.6% for the week. So again, all these trades working out very nicely. And then we had a long on MPC. This is Marathon Petroleum. This stock was down 1.3%. We had a diagonal call spread. The diagonal call spread is a very mildly bullish trade with a risk graph that looks something like this. And what happened was this stock just moved its way down here, somewhere along here. I believe this trade is slightly negative, but this thing still has some more time as well. So look, you want to be more short than long. We've been talking about that over the last couple weeks. I just want to make sure that everyone understands we step back from what's going on right here, right now, and really see the big picture and really see that we are in this period of seasonality that's usually pretty nasty. So let's break down the numbers, let's close the week off, and let's really focus on the next couple weeks ahead. Taking a look at the market performance, we see that the Dow was the worst hit here, down 1.3%. The industrials was not a great sector. We had the S&P down about 0.75%. We actually had the Qs and these small cap stocks, the Russell, basically flat on the week, oil up a little bit, and take a look at gold. That is a big number. Gold does not move 4% in a week. It got absolutely hammered this week. Now, gold has been holding up really well. Gold and the US dollar are typically inversely correlated to each other. The US dollar has been very, very strong, and gold hasn't really been falling. I kind of feel like the trade caught up to it, and gold really took it on the chin, especially on Friday. But let's take a look at the charts, because that's what we really care about is the charts. As you can see here, we broke below the support. Here. And we got down, and on Wednesday, we talked about how, okay, we got this hammer pattern, and we said, okay, if we see a green candle on Thursday, which we did, then we're looking at a bear rally. A bear rally, and we said we think it's going to come back up to this point and likely turn around at this point. It got there pretty quickly, and we got this gap up. Again, this gap up was from the good inflation numbers, and you can see nothing but selling. That was a very, very ugly candle. So yes, we did get a little bounce on Wednesday, but there was really no follow through whatsoever when it hit a resistance point. If we take a look at the Qs are actually doing a little bit better. They were holding on to this support area. Same thing, we got a doji, we got our confirmation candle, but we said, look, we just don't see this coming up. All the moving averages are going down. We're making lower swing lows. Everything looks bearish at the moment. So any rallies should be sold here over the next week or two. This is the big story. And we've talked about how the bond market is the head of the dog and the stock market is the tail of the dog. Wherever the head goes, the tail is going to go with it. And we had a clear breakout all the way up to 4.7 up at the high. We backed off, but look at the candle on Friday. There are still buyers out there in bonds, well, sellers here. Bond yields are likely going to continue to go higher, which is going to put some pressure on stocks. So the outlook we have here, you have to be bearish. And I talked about this 2 or 3 weeks ago. I said, look, I don't feel like being bearish. I feel like the economy's doing okay, things are doing okay, but the charts told me to get bearish. And I had to get bearish, and I'm glad I got bearish because it's working out quite nicely. I want everybody to be wary heading into October. We've talked about the seasonality. We talked about the government shutdown. If the government shutdown is over and seasonality is over and maybe the auto union strike looks like it might be over, this down move is most likely not going to hold. So I just want you to be prepared. I don't want anyone trying to go long thinking that they're going to get ahead of it. That's not what we do here. We trade the market in front of us. But I want everyone to understand where we are in these patterns. I think we're likely in the 6th, 7th, 8th inning of this down move, and we likely could have a decent bounce. Look, I'm not bullish by any stretch of the imagination, but I think that this down move is likely going to be coming to an end here fairly soon. Looking at the calendar, we are at the first week of the month. That means we get manufacturing PMIs, we get JOLTS numbers, and we get the payrolls report. So let's take a look at Monday first. Monday, we have ISM manufacturing. Also, we get Fed Chairman Powell speaking. On Tuesday, we have the JOLTS job openings. These used to be above 10 million. Look at how much they've come down. They've come down substantially. That's what the Fed wants to see. And then on Friday, we've got the payrolls report, 168,000 jobs. Compared to what we've seen over the last 2.5 years, this is a normal report. And if it comes down to these numbers, the market's going to be very, very happy with the progress they've made on the jobs numbers. So overall, again, the jobs numbers are showing that the economy is starting to slow down, just like what the Fed has been wanting to orchestrate. What does that mean for the markets? Well, where we are right now, and again, I'm going to say this 100 times, trade the market in front of you. I just talked about how we could be at the end of the seasonality. And I put that in your mind and you're thinking, oh, okay, maybe I shouldn't be as bearish as I need to be. No, that's not what I'm saying. I'm saying to understand where we are in the entire cycles in the entire year, because when you take a look at a chart, it's a -3. We're below the 20, we're below the 50, and the slope of the 20/50 is clearly moving lower. We are below everything. All I'm saying is you may not want to go short in positions that don't expire for 2 months. That's really what I'm saying. I think you keep your bearish trades more on the short side of duration and really, again, pick your shots here over the next 2 weeks. I've got a 0 on the week. I think we could be a 0, -1. Look, whatever happens over the weekend with the government shutdown is likely going to set up what happens next week. We also have some China manufacturing numbers out Friday night that's also going to play into it. But look, we'll just see. But we saw that this week, any rally the markets had was sold pretty quickly here. So until things change, I think we got to stick with that bearish outlook and that bearish lane. Let's take a look at the sectors. Many people are unfamiliar with exactly what proprietary trading is. Prop trading is when a private firm hires traders like you to trade with their capital. Those traders are paid a percentage of the profits that they generate for the firm. Profitable traders are awarded higher and higher levels of capital to trade so they can take bigger positions and make more money. We've been in business for over 25 years and we're one of the oldest prop firms based in the USA. If you would like to look into being a trader for Maverick, look in the video description below and click on the trader position to apply. Now, the thing I really want you to keep your eye on is what sectors held up this week. And here we go. The first sector I want to talk about, communication services. Comm services is a weak sector, but it held up. What else held up? Consumer. Consumer actually positive. What else held up? Materials. Again, of course, energy. Energy's been outperforming anyway, so let's point to energy too. But what has held up that has been going down substantially? Tech. Tech has actually done okay too. So these are the sectors. If you want to start looking for some bullish things that you can hold for maybe into November or December, these are the 4 sectors you want to shoot for. What were the sectors that didn't hold on? Utilities got hammered, real estate hammered, financials hammered. Those are not where you look for potential bullish trades into November and December. Healthcare, industrials, I don't like those either. Look, we've got 4 great sectors here that we can start to take a look at. Let's break these all down one by one and give them a score. Last week, utilities was at a -1. It is now at a solid -3. We got nothing but selling on heavy volume. Okay, we could have a bounce. I don't care. You want to be sellers of any bounces in utilities. Let's come over here to the communication services sector. This held in very nicely this week. As you can see here, these moving averages are basically flat and moving sideways. We don't have any real ugly price action. We are not down below our lows that we had in August. So for me, this is still a -2. It's still below the 20, still below the 50, but I'm going to give it a -2 plus. It's holding up nicely compared to others. We come over here and we say, oh, this is not holding up nicely. Remember, communication services is holding this support line. We fell through it and we fell hard, and we are not able to mount any sort of bounce here off the bottom. Real estate is now at a -3 from a -2. So real estate has weakened quite a bit. Come over here and take a look at the industrial sector. The industrial sector was at a -2 last week. It is at a -3. Very, very nasty week. We had no bounce whatsoever here on industrials. So I think you have to keep industrials at a -3. Healthcare, same thing. We are not holding any levels whatsoever. We saw communication services hold levels. This thing went down more this week. This looks really terrible. This is a -3 in the markets. Come over here to the financial sector. I'm still going to give this a -2. We're fairly close to this last support, hanging on here. -2, -3. It still looks terrible. So financials is not where you want to go looking for bullish trades. It's better off for bears here at the moment. Switching over here to consumer. Consumer is still a -2. Still a -2. You can see we went below that support line, but look, we came back. And we're actually back up to that line. Things don't look great. I'm not saying it's wonderful, but take a look at the market. But take a look at the week it had. It had a really nice bottom, and it actually is one of the ones that actually came back up above resistance lines. Here is technology. I'm going to stick with, again, it's -2, but it's a -2 plus. We're holding these areas here. We're not clearly below August support like so many other sectors are. Coming over here to materials. Materials was a -3 last week. I'm going to move that up to a -2. We had a nice bounce on this one. Look, it's still terrible. It's just not as terrible as it was last week. Finishing off with the energy sector. The energy sector was between the 20 and 50 last week. We're between the 20 and 50 this week. So we're just going to leave it where it was at a +1. So if we take a look at where we were last week, this is where we were last week. What did we see? We saw industrials and utilities fall. And we saw materials get a little stronger. And then the only other move we saw, and I'm going to have these two, these are still -2s. But these are the -2s that are actually looking a little bit better than everything else. Consumer was actually positive for the week. Comm services was flat for the week. These are the areas I want you to start looking in for some potential bullish trades when we get out of this negative seasonality pattern. So let's go take a look at some of those sectors and try to find some potential trades for us to put on here. In comm services, let's take a look at good old Meta. Now look, I don't like calling it Meta. I like calling it Facebook. Why? Because Facebook got such negative press that I felt like they changed the name to try to get away from their negative press. So because of that, I'm just going to keep calling it Facebook. So anyway, let's take a look at where it is. This stock has been holding in really quite well. And you can see here, as the market has been going down lately, it's been parked. It's been parked at 300. Really, let's take the low down here at 290. Right here in the low, and the high up here around 312. So I want to take a look at just doing a butterfly. Now, I do think that this market is going to change in the next 2, 3, 4 weeks. So if you can take a look at my trade, I'm not looking to stick around all that long. I'm not saying Facebook's not going anywhere for the rest of the year. I'm saying Facebook is likely to hang out here for the rest of the week. I'm looking at a very short-term trade on this. I'm not sticking my neck out too far because, like I said, I see the potential for a change in where the market is right now. And if that happens, then that's going to trigger this trade. So I want to be very short-term on this one here, October 7th, a 1250 spread here between 287.50 and 312.50. Let's go on next to healthcare. Healthcare looked terrible. It was one of the worst sectors. It fell to new lows this week. I'm looking here at Teladoc. This is a terrible looking stock chart. And we had a big fall. And you can see here, we've got this base here forming. And not just a base, but this is what is called a low and tight base. Whenever you see these, you typically get about 5 candles, and then you get a fall from these levels. It doesn't always happen, but typically 5 of these really narrow candles is impetus for it to go a little bit lower. So what's the trade? Very wimpy trade, October 13th. So again, we're going out 2 weeks. I don't want to stick my neck far out past that seasonality period of October 15th. So I'm just looking for basically a very small move, 18 to 19 bear call spread. This is of chicken. We call it chicken bulls or chicken bears here at Maverick. That's what I'm looking to play between 18 and 19. That's a really chicken trade here, but it's going to give us probably about a 3-to-2 risk-reward ratio on this one. Going next to consumer. This is a sector that held up well. I want to start looking at some bullish stuff, and I'm willing to go further out. So take a look here. It's October 27th. So now I'm past that seasonality period, and I'm looking to do a diagonal call spread. It is not a bullish trade. It is a +1 style trade. So I'm going to look at buy the 95 and sell the 100. Let's take a look at this chart. Here's the 100 right here. That is my max gain point on a diagonal call spread. So as you can see here, I am not playing this aggressively. I'm basically saying I think it sticks in this area here for the next week. That's it. And then after that, maybe we get some moves up and I can hold on that long call. But for this week, I'm going to stay in a diagonal call spread for 5 days, reevaluate it on Friday. I wanted to find a trade on the short side. So what I love to do in these kind of bearish markets, I love to see the massive bear rallies on very weak stocks. So one of the weakest stocks has been Alcoa, and it's been weak ever since the summer. Look, we've been in a bull market all the way through the summer. This thing's been falling. And what happens is these things have these big gains. So here it went from $28 up to $31. That's $3. That's like an 11% gain. Very short amount of time. And then you can see it falls. Then we had a 2-day rally here, probably about 6%. And then it falls. This last rally has been 25.50 all the way up to 30. Do you realize this has been about a 20% rally? So whenever I see a weak stock that's had a 20% rally in 3 days, I start to lick my chops and say, I love these kind of bear rallies. As you can see here, we had a pretty terrible candle here. This is called a gravestone doji. It's an ominous sounding name. I like this one. The only question is, how am I going to play it? What's my duration? I'm going to keep it short. Remember, I think the bearishness in this market could potentially be gone after October 15th, so I want to squeeze as much as I can out of these moves. I'm looking for the October 13th, 27.30. And you can see I'm just looking to play right here. I'm looking for it to go back down below 27. I don't need it to make a new low. I don't care if it does. I just want it below 27 is the price. Now, because this market is potentially in flux and about to change in the next 2 weeks, I'm only going to be doing 4 trades here in the trading room. The reason is I want to have everyone kind of calm down their trades. If you've been piling on bearish trades, great job. You've got some great profits. Let's just start to back off a little bit. Let's just start to back off. Look, if it's wrong and the market keeps going lower, we'll pour the bearish stuff back on if we need to. But I don't see the need to go really longer term bearish past October 15th until we see what happens. If there's any trades you want to share with the rest of the group Mavericks, you guys know where to go. Log into the website, go into the forum. I love to see the dialogues going there between our traders to help the rest of the group make money. Let's go ahead and wrap this up. We got a bearish outlook, but again, 2 more weeks. It might just be 1 week. It might be over. We have no idea. I'll say it one last time. I don't think you want to stick your neck out on the bearish side past that October 15th. But I don't think you want to be looking to be a buyer here over the next 2 weeks. I think you either stick with what you got, add on a little bit more sideways stuff, or just wait until we get that resolution here. Focus on the sector strength and weakness. It's telling you everything you need to know. And everyone have a great weekend. Thanks for joining me. Goodbye, everyone.